Good evening. Welcome to CS Sri Lanka webinar series, day 2. So, very first day we discuss conceptual framework for financial reporting. So, if I take you all through a quick revision on that, if you can remember yesterday we opened conceptual framework and I asked you to highlight important areas of that conceptual framework, and my advice was to visualize, conceptualize whatever the learnings that you are doing or you are taking from me or from your classroom or self studies to a conceptual frame summary, conceptual visualization, and to the same conceptual visualization I ask you to take the relevant paragraph as well. Why? Because don't forget, you should not remember anything for the exam. All these things are there in the standards and the relevant study material. You should know all these things. That is more than enough to handle exam questions. So, keep all these things in your mind, right? Otherwise, from A level, O level, from your executive level, if you continue the same way of studying, it is very difficult to pass this exam, right? Fine. Always I am remembering these things for your benefit, right? Fine, okay. Before we move into today's topic, which is LKS 36 impairment, I wanted to take few exam questions from your CA Sri Lanka past papers. We'll take few questions relating to yesterday's sessions, which is conceptual framework. Then we can move into discuss straight away LKS 36, right? Fine. That is the core topic today. According to yesterday's learning, I told you when you measure financial statements elements, subsequently you will measure assets, liabilities, equity, income and expenses based on these values. What are they? Historical cost, it can be current cost, or it can be realizable value, or it can be present value of future cash flows, present value basically. So, these are the 4 valuation techniques. So, when you measure assets, liabilities, equity and income and expenses subsequently, so these are the 4 methods available, right. So, historical cost means, let us take your property, plant and equipments. If we apply historical cost for PPE, historical cost means cost minus accumulated depreciation. Basically, your carrying amount is represent your historical amount. Current cost means the value of similar assets, value of the similar assets, which means when you sell your existing assets in the market, so to what price you can exchange it, current value. Realizable value means the existing, let us say, assets when you sell in the market, how much you can realize, which is realizable value. Present value of future cash flow means if you use assets for a longer period without selling it, those assets will generate future cash economic benefits to the entity. So, asset recognition criteria clearly explain you that, right. Assets means what? Resource controlled by an entity to generate future economic benefits, inflows, and it should be able to control by the entity. So, when you generate future cash flows to the entity, you have to discount by using discount factor. So, then you can derive the value, which is present value of future cash flow. So, they have tested these subsequent measurements during in December 2016 paper, question number 1 part B. Let us take that question. Alco Private Limited acquired a machine by paying 10 million on January 2014, which has useful life of 10 years. So, asset has useful life of 10 years. On 31st December 2015, after 2 years, the management estimated that this machine can be sold in the market only for 7.5 million, incurring the selling cost of rupees 100,000. However, if it used in the operation to generate future cash flows, it would give a present value of rupees 8.5 million over its remaining life. What do you need to do? Required, explain 4 measurements. Don't forget that action verb, explain. Explain 4 measurement bases referred to the conceptual framework for financial reporting using the above information as at 31st December 2015. So you have to explain 4 measurement bases using conceptual framework when you value these assets, right? Fine. We'll take one by one. So there are 4 measurement bases: historical cost, current cost, revaluation, realizable value, and present value of future cash flows. Straight away, when you're familiar with information, take those information to these 4 methods. So then easily you can fill the balance part of it, right? Fine. So if you read the last sentence, however, if assets used in the operations to generate future cash flows, it would give present value of rupees 8.5 million over the remaining life. So then present value of future cash flow, how much? 8.5 million. 8.5 million. So then they are telling you again, on 31st December 2015, the management estimated that this machine can be sold in the market only for rupees 7.5 million. You can sell this machine in the market for 7.5 million, which means you can realize 7.5 million. But the problem is, when you sell this asset in the market, you have to incur a selling cost of rupees 100,000, which is 0.1 million. 0.1 million. Altogether, realizable value of this asset amounting to 7.4 million. So then another 2 measurement bases are there. We need to check whether those informations are available or not in the given case study. So if you read the first paragraph, first sentence, Alcohol Private Limited acquired a machine by paying 10 million and on January 1st, 2014, which has useful life of 10 years. So you have to value, you have to measure this asset after how many years? 4 years, 2 years, right? So you acquired this at 10 million. I told you historical cost means cost minus accumulated depreciation, which is carrying amount. So after 2 years, so this asset worth has 10 years lifetime, but you required only 8 years. Why? Because already 2 years you have depreciated, right? From 1st April 2014 to 31st December 2015, which is 2 years. So if you take carrying amount of this asset at the end of 2 years, 8 million. So we know historical cost, and you have realizable value, which is 7.4, and present value of future cash flows 8.5. Now the question is current cost, right? Current cost. But in this question, they have not given you the current cost. Only 3 measurement bases they have explained in this case study. Now when you write answer to this question, when you write this, you might not be able to take how much? 5 marks. So they are giving you 5 marks. To take these 5 marks, you have to use conceptual framework and explain. Now I am trying to tell you the way you should answer this question. Now if I am the student, let's say, now I can't remember a relevant paragraph for this subsequent measurements, right? No need to keep this in your mind. That's the problem. All of you are trying to take these paragraphs in your mind. Don't do that. Why? Because the examiner has clearly told you, you can bring these study materials. So, but you should know the place to find this relevant paragraph. Since this is an open book exam, you can't purchase your study materials today from institute, and you can't sit for the exam tomorrow. You have to do some pre-preparations, homeworks. Those homeworks I explained you yesterday. Visualize this, take relevant paragraph to that conceptualization, so then you can go for the exam. If you have that summary, you know, according to conceptual framework, paragraph 4. What is the paragraph number? 4.55. Even I have to refer the conceptual framework to find the paragraph. I can't remember all these things. Should I remember these things? No. Student should be able to apply his knowledge. No need to keep things in your mind. Right? This is not an O-level exam, A-level exam or zero-level exam. So for those exams, you have to keep these paragraphs in your mind, counting standard numbers and everything. But here, no need to do that. So according to concept, this is the way you should structure your answer. According to conceptual framework, assets, equity, liabilities, income and expenses can be measured subsequently using 4 measurement bases. Those are historical cost, current cost, realizable value, present value of future cash flows. That is the first sentence. No need to explain what do you mean by historical cost and current cost, realizable value, present value of future cash flow. The definition of all these things no need to repeat. Why? They are given only 5 marks. So then second statement should be bullet points. Use bullet points. Don't write 1 page. When examiner asks you to explain, you explain in a bullet form. So you have to, first bullet point should be straight away. You can copy and paste it from where? Conceptual framework. That I have explained to you. Second statement or second point should be, according to the given information, Alco Private Limited acquired this machine on this day. When it's come to 31st December 2015, historical cost of that asset is the current carrying amount, which is 8 million after depreciating asset for 2 years. So then current cost they have not given to you, realizable value 7.4 million after deducting 0.1 million as what? Cost of sales. And present value of future cash flows they have given straight away. How much? 8.5 million. So clearly you have explained what? 4 measurement bases. That's all. If you write that, you will take how much? 5 marks. Is it easy or difficult question? Very simple question. But the problem is, you will not use this word action verb. What it is? Explain. You are hurried to answer these questions. You are very much busy with what? You are very much busy with consolidated questions. Right? Am I correct? Yes. But you are ignoring all these things. 1 mark is matter. Most of you will end up with 47, 46, 45 because of this. You will not answer these questions as examiner is expecting. So you have to cater to examiner's requirement. Use conceptual framework, take information from that and apply your knowledge to this case study and explain then the case study information. That's all, right? 5 marks. So I'll take another question, simple question before I move into impairment standard. December 2015. December 2015, question number 1. December 2015, question number 1. Read it. iSecurity PLC is a consultancy firm which provides consultancy services in relation to information technology, IT, security to corporates. Recently, the management of the company has taken following decisions. What are the decisions? 3 employees of the company were sent to Singapore for IT security training and in order to develop their job related skills. So 3 employees the company has sent to Singapore for a special training. The total expenses incurred for this training were rupees 1.2 million. So now you have to understand whether you can follow this accounting treatment. The management has decided to capitalize this expense as they will give rise to future economic benefits to the entity. Now you have to go back to these 5 elements and think this is related to which element. So future economic benefit will flow to the entity. Yes, you can understand and measure future economic benefits. Fine. So then one criteria has met, asset recognition criteria. And resource controlled by the entity as a result of what? Past event. Yes, it is as a result of past event. It's a resource of the company, employees, human resource. it's a resource of the company, but the problem is what? Whether that can be controlled or not. 3 employees in your payroll, can you control human resource? No, it's beyond the control of you. So you might not be able to control them. Because of that, it has not met the asset recognition criteria. So very simple question, but you should know the real definition of an asset. If you don't know the definition of asset, if you misinterpret it, you might not be able to answer this question. So understand it. All other criteria has met. It's a resource as a result of past event. Economic benefit will flow to the entity in future. So fine, but the problem is what? It is uncontrollable. Therefore, you can't recognize this as an asset. Therefore, you can't capitalize. So how do you answer? So this is the way you should answer. First of all, you have to read the examiner's requirement. Discuss. Don't need to identify, state, all these things are irrelevant. Discuss. You have to explain the decision taken by management in Roman number 1 and 2 above with reference to the conceptual framework. Right? Now, conceptual framework you have to use to answer this question. Right? Conceptual framework clearly explain element of financial statement. So this is Roman number 1 relating to asset recognition. You have to tell according to conceptual. First bullet point. This is the way you should answer. Understand this. Right? You will read the answer. You will listen to me, but finally you have to write. When you write, these points should be there in your answer. Right? To be a complete answer. Right? How do you answer? According to conceptual framework, to recognize assets in your books or in your financial statement, these criteria should be satisfied. What are they? It should be a resource controlled by the entity as a result of past event, and future economic benefit should flow to the entity, and it should be controllable. If it is not controllable, you might not be able to recognize this as an asset. So that statement you have to write first. Straight away you are taking that from where? Conceptual framework. Then you move into the case study. According to the given information in the case study, so these 3 employees are not within the control of the entity. It is beyond the control of the entity. Because of that, asset recognition criteria has not been met. Right? Therefore, entity cannot capitalize this expense in their books of accounts. That's all. That is a complete answer. How much they have given? They are giving you 5 marks. To take 5 marks, you have to use conceptual framework. Roman number 2. The company has raised a purchase order for procuring 3 modern laptops. The laptop will be available to the company only after the financial year end. The management has decided to recognize a liability at the end of the purchase of the laptop. The management has decided to recognize a liability at the at the year end for the purchase of laptop. If you read first paragraph, second paragraph, the laptop will be available to the company only after the financial year end. Right? Now they are trying to recognize this as an liability. But assets will be available after the financial year end. At the end of the financial year, can you recognize this as an asset? That's the problem. Now you have to use conceptual framework. According to conceptual framework, to recognize a liability, these conditions should be satisfied. What are the conditions? It should be obligation as a result of past event. There is no past obligation. There is no obligation. Right? There is no present obligation. As a result of past event, there should be a present obligation. But right now, you don't have an obligation. Why? Why don't have obligation? Laptops will be available when? After the financial year end. Therefore, asset recognition criteria will not be met. That is the answer. To take 5 marks, you have to write that. So those are the very simple questions, I would say, your examiner has tested so far from conceptual framework. There are more questions, but due to limited time, we might not be able to go through entire set of past papers. I have done 4 past papers, I believe. Yesterday we have done 2 past papers, and today we have done 2 past papers relating to conceptual framework. Right? Fine. So with that, I will move to discuss a new standard, which is impairment test. Impairment, asset impairment, LKS 36. Right? Fine. Here also my advice is don't try to remember anything related to this standard. Try to absorb the knowledge, know this standard, but don't try to remember this thing. Why? This is an open book exam. Right? Fine. So standard name is what? LKS 36. 36 and name impairment of assets. Impairment of assets. Impairment of assets. So first of all, you should understand what do you mean by impairments, right? First of all, you should understand the definition of this. What do you mean by an impairment? Now let's say, I will take simple example before I move into complex areas of the standard to explain this. Now let's say you purchase a vehicle, let's say a machine at 10 million, right? So we will depreciate over the period of whatever the years. Now let's say after 2 years, the carrying amount of this asset, carrying amount means cost minus accumulated depreciation. Let's say 8 million. So carrying amount of this asset equal to 8 million. Now the technology has developed over this machine, right? So now today's context, technology always keep on change. If you look at mobile phones, if you purchase one, let's say you have a mobile phone, after 2 years you might not be able to sell at the market for a higher value. Why? Because technology always keep on change, right? New versions, new additions will come to the market. As a result of the existing assets value will be dropped. The same thing happened to this machine, let's say, right? So after 2 years, you can sell this asset. Sale value, let's say equal to 6 million, right? Realizable value, recoverable amount. You can recover this much, 6 million. Now in your books of accounts, you will show the asset value as 8 million, which can be sold in the market, at 6 million. What is the problem according to conceptual framework? If you apply conceptual framework, you should be able to think now. Yesterday we discussed, when you present financial statement, now you have presented what? 8 million in your balance sheet. But you can sell this machine at 6 million in the market. The problem is what? According to conceptual framework, when you provide financial information to whom? Intended users. Who are they? Investors, lenders and creditors, for their economic decisions, to take economic decisions, those financial information should have 2 basic characteristics, fundamental characteristics. What are they? Information should be relevant for what? To take economic decisions. And information should be faithfully represented. Faithfully represented. Faithfully represented means it should be unbiased, all information, without error, omissions, you should be able to report in the financial statements. Now here, is it faithful representation or not? You can sell this asset in the market for 6 million, but you are showing the asset value as how much? 8 million. Now, can you take economic decisions? You have overvalued this asset in your books of accounts. Yes, you have purchased this at 10 million. Now, according to depreciation, when you apply, it's 8 million. But you can't realize 8 million from the market. Which means your asset value has dropped to 6 million, even you have represent in your financial statement as 8 million, which is not the faithful representation. The current representation in your financial statement is not the faithful representation. So, which means you have 2 million impairment. So, this is what the impairment in simply. This is what the impairment, right? You can't recover this much, 8 million, but you have shown as 8 million, you have to written down or you have to reduce value to 6 million. For that, you have to do what? Impairment. So, impairment means you have to pass these two double entry. Not two double entries, this entry. You have to charge 2 million to a P&L debit, your asset, credit, 2 million. So, this is the overview of the standard. So, I have explained this in a simple way, nice. You will see, you will think, right, what is this impairment? Very easy, no. When it's come to business, it is not that easy. It has complex scenarios. All these complex scenarios and the application of this, for what we can apply, the scope of the standard, everything we have to discuss. Right? Fine. We will take the standard to explain this in detail. Right? So, now you have a simple understanding about the standard. Right? Fine. Before I go to the relevant standard, to show you the relevant paragraph, I will take first, I will try to conceptualize this as much as possible to make it easy, right. So, then to the same conceptualization we can advert the relevant paragraphs also, right. So, you have one simple visual conceptualization in your standard book with relevant paragraph. So, no need to go through entire pages relating to the standard, if you can do so, right, fine. Okay. So, I will try to do it, the same you can do with me, right, fine. So, here when it's come to impairment, right, impairment, it is the difference between, I told you in my very first example, difference between the recoverable amount and the carrying amount. Recoverable amount and the carrying amount, right. To have impairment, to say asset has been impaired, the recoverable amount should be lower than the carrying amount. So, carrying amount should be higher than the recoverable amount. If so, you can say asset has been impaired. Asset has been impaired. So, simple, right. Now, how do you take the recoverable amount is a problem. How much you can recover? So, when you find the value, subsequent measurement of an asset, you have 4 bases now: historical cost, current cost, realizable value, recoverable value, or present value of future cash flows. Present value of future cash flows, right, fine. So, when it's come to recoverable amount, we can identify recoverable amount in this way, right. You can recover this like this. Either you can use this asset present value in use, which means value in use means if you use this asset without selling the market till the end of the lifetime of this asset, how much you can generate as cash flows. Value in use, if you use, how much the value of this asset, right? How do you find out it? You have future cash flows of this asset, right? That is the present value, right? That's a cash flow you generate in future. And you have to discount by using what? Appropriate discount factor. We call it as what? Present value of future cash flows. Present value of future cash flow, which is the value in use. If you use this asset in the market, in your day-to-day operations, how much you can generate as benefits, economic benefits. Future cash flows into discount factor. You have to discount it using company discount factor. Or else recoverable amount means fair value of this asset, which means market value. Fair value minus cost to sell. Cost to sell. So if you sell this asset in the market without using it, you have two options to recover this value. Either you can use, if so, present value of future cash flows, or else you can sell in the market, if so, fair value minus cost to sell. To sell this asset in the market, you will incur some amount of cost, right? What are those cost elements? Don't worry, we don't know, you don't know, I don't know. Who has given that guideline? LKS 36. We'll come to standard later. First of all, we'll understand this model, right? So fair value less cost to sell is the amount you can recover if you sell this asset in the market. Without selling this asset in the market, if you use this asset in your day-to-day operations, your value of this asset you can, how do you derive? By discounting future cash flows, which is future present value of future cash flows. So then you can derive what? Recoverable amount. Recoverable amount. So then you can compare with what? Current or carrying amount. So then you can see whether asset has been impaired or not. So this is the simple understand or idea behind impairment. So I will take simple example to explain further this. You can understand the standard overview with this simple example, right? Fine. Read this question. In each of the following situations, identify whether the asset is impaired or not, right? So asset is impaired or not. Read first one. The carrying amount of this of a machine is rupees 69,500. They have given you carrying amount 69,500. 69,500. 69,500. Its value in use rupees 68,500. Value in use 68,500. 68,500. And its fair value is rupees 70,000. Fair value 70,000. All these numbers they have given to you. Cost of disposal, cost to sell. How much? Cost to sell rupees 600. Rupees 600. When you sell this asset in the market, you can realize 70,000, but to sell at 70,000, it will incur 600 rupees. Now we have to see whether there is impairment or not. Look at this board. Now, if you read numbers again, value in use 68,500, fair value less cost to sell 69,400, which is fair value minus cost to sell 69,400. 69,400. Now, what is the recoverable amount? You have two values, fair value less cost to sell you have, value in use you have. If you use this value in future, you will generate present value of 68,500. But if you sell this asset in the market right now, today's 69,400 we can realize as net gain. So what is your decision? If you continue this, what happens here? 68,500, right? 68,500. But if you sell this, 69,400. So rational investor will do what? What is your economic decision here? So you have more benefit when you sell this in the market. So recoverable amount means higher of these two, right? Whichever is higher, you will take as recoverable amount. Don't forget that, right? When you compare fair present value or fair value less cost to sell, fair value less cost to sell and value in use, you have to take what? Whichever is higher. With numbers you can see, no? What are 68,500, but in 69,400. Definitely, you will take how much? 69,400. So your recoverable amount 69,400. 69,400. This is the maximum amount you can recover this asset. But if you look at the current carrying amount of this asset, 69,500. Okay, pottola pennagana inno 69,500, but actually the asset value how much? 69,400. 69,400 වෙන asset එකක් වා 69,500 කියලා තියාගෙන ඉන්නවා. Is that faithful representation? No. That is not the faithful representation. Which means asset has been impaired by how much? 100. This is what the impairment loss. You have impairment loss. The standard explain this. Now with numbers you can understand, I believe, right? With numbers you can understand. If you read the second part of this question, now see the second part of this question, read it. Second part of this question, the carrying amount of property is rupees 4.5 million. I will erase these numbers to explain you the second example. Right, erase this and take second example. The carrying amount of a property rupees 4.4 million. Carrying amount 4.5 million. Quickly we can do this, right? The property would be sold on open market for an estimate 5 million subject to 10% agency fee. So when you sell this asset in the market, you can sell this at 8 million, 5 million subject to 10% agency fee. The value in use has been estimated 4.4 million. Value in use 4.4 million. Right? Now if you sell this in the open market for the estimated value of 5 million subject to 10% agency fee. 5 million is the fair value and you have to incur how much? 10% agency fee out of this minus 5 million into 10%. So then you can take what? Fair value, right? Do this calculation. Now if you take %90 of this 4.5 million. 4.5 million. Now compare fair value less cost to sell and value in use, which is higher, 4.5 million. Now your recoverable amount also 4.5 million and your carrying amount also 5.5 million. The difference is nil. So no impairment. Exactly, your carrying amount is tallying to what? Recoverable amount. No impairment. Now you can understand this. Very simple, through very simple examples, right? Fine. So before I move into the complex scenarios, now the purpose of this webinar series is to guide you for the exam, right? So no point of doing all these calculations if you don't know the relevant sections or relevant areas of this standard. Now take your accounting standard LKS 36. I will explain LKS 36 very clearly. So then you can have a summary of this paragraph as well to the same conceptual visualization. This visualization should be there in your standard book. Wherever, find an empty page in the close to the in the same accounting standard. So then you can nicely draw this visualization and insert relevant paragraph also to this, right? Fine. Now keep this. We will try to develop this with some additional information, right, when we go through the standard. So standard explain you the objective, scope, definition, identify an asset that may be impaired, and measurements and recoverable amounts and cash generating, so and so. All these things a little bit complex, but we'll see from the beginning what are the important areas that we need to identify, right? Fine. Objective I have already highlighted, so same thing you can highlight it in your study, in your accounting standard book. You can highlight, doesn't matter, right? It is allowable, right? So objective explain. If this only I am not trying to read the entire paragraph, but important things I will explain, right? If this case the asset described as impairment and standard required entity to recognize impairment loss. The objective of the standard is to identify if there is any indication of impairment, you have to calculate it and identify the impairment loss, right? So objective is to identify impairment loss, right? The standard also specified when an entity should reverse impairment loss and prescribe disclosures, right? Today you recognize impairment, but at the end of next year, the asset may be appreciated sometimes, not impaired. So then how do you treat for those situations? That is the objective of this standard, right? Don't keep things in your mind, right? Just highlight and know it, don't try to remember, right? There are many things in it, I know. With these things, if you are trying to archive this accounting standard book to your head, it is very difficult task. You can't do this. Even I can't remember these sections, right? That's why standard book is available. That's why CS Sri Lanka website, all this accounting standard has published. If you remember all these things, no point of having this study material in your website or no point of having this big book. Know it. You should be able to apply this in the exam. That's what it's required, right? Fine. So scope, very much important. Highlight and put 3 star marks if you want. Why? I explain you. This standard shall applied in accounting standard, accounting for impairment of all assets other than, underline the word, all assets other than. This is much more important. Highlight it, right? All assets other than these things. Inventories, LKS 2, and SLFRS 15, revenue from contracts with customers. It's a new accounting standard. Replace LKS 18. Deferred tax asset, LKS 12 income tax standard, and LKS 19 employee benefit, SLFR 9 financial instrument. So for this standard this will not be applicable. How the accounting standard? Investment property that is measured at fair value, LKS 40, underline the word fair value. Biological assets, agricultural activity with the scope of LKS 41, agriculture that are measured fair value, less cost to sell. Deferred acquisition cost, which is SLFRS 4, insurance cost. Non-current assets classified as held for sale accordance with SLFRS 5, non-current asset held for sale and discontinued operation. Why these standards are not within the scope, other than, right? So if I explain you, right, this is applicable for not only to this standard, for each and every standard. Hamma standard ekkama tiyenawa scope කියලා paragraph එක. So this scope will clarify what is in, what is captured to this standard and what is out of the scope. So what is in, what is out of the scope. So you have to clearly understand that, otherwise you will mislead it. If not, you will try to apply this to what? Inventories as well. Hey, asset එක. Right? You will apply this to what? Debtors. Why? Asset එක. But this standard itself, they have explained this impairment. right? These standard itself, they have explained how they are impairing these things. Therefore, if they have explained their own, why do we capture to this standard, LKS 36? Whatever not captured in their own standard will be captured in LKS 36. තනි ස්ටෑන්ඩඩ් වල ඉම්පයර්මන්ට් එක ගැන කතා කරලා නැත්නම් ඒ ස්ටෑන්ඩඩ් කොහෙද කවර් වෙන්නේ? LKS 36. All these standards they are talking about their own impairment in the relevant accounting standard. Therefore, we will consider only these things in the standard. I have highlighted this also, paragraph 5, right? So here you can make a note, para 5. Paragraph 5. This explains impairment, right? This standard does not apply, if I read it for you, it does not apply to financial assets within the scope of SLFRS 9, investment property measured at fair value. If you measure it at fair value, is there impairment? No, fair value means what? Always you measure at market value. Fair value means market based valuation method. When it comes to SLFRS 13, we will discuss. Fair value means market based valuation method. So therefore no impairment, therefore it is out of the scope. LKS 40, biological asset related to agriculture activity measured at fair value again. If there is a fair value measurements in the relevant standard, those things will not capture to this standard. Sell less cost to sell, LKS 41. However, very important, I have highlighted, this standard applies to that are carried at revalued amount in accordance with accordance with other SLFRS. එහෙනම් මේක මොකටද apply වෙන්නේ? Applies to assets that are carried at revalued amount. That is fair value at the end of the revaluation less subsequent accumulated depreciation and impairment loss in accordance with other SLFRS. මොනවද ඒවා? Such as revaluation model of LKS 16. LKS 16. එහෙනම් මේක apply වෙනවා මොකටද? impairment apply වෙන්නේ. LKS 16 property plant and equipment. And revaluation model that is fine. Then LKS 38 intangible assets. LKS 38 intangible assets. For this, the standards will be applicable, right? So then whatever measured at cost, the standard will be applicable. And biological assets measured at cost as well, right? Biological assets measured at cost, which is LKS 41, right? All these things, all these standards, if it is fair value, this standard will not be applicable. Intangible assets measured at fair value, biological assets measured at fair value, the standard is not applicable. But biological asset measured at cost model, if you follow cost model, you have to apply impairment. So all these things you apply what? Cost model or revaluation model. Revaluation means what? Revaluation or value minus accumulated depreciation minus impairment. So don't forget to keep this in your mind. You measured these things as cost, for those impairment standard will be applicable. Other standards, they have explained impairment in their own standards, right? LKS 36 talked about these things. That's all, right? Scope explain you that. With that, we'll try to definition you can read at home, doesn't matter, easily you can understand, but when we go through the standard itself, we will identify. Identify an asset that may be impaired, right? So this is also little important, right? Fine. Before I move into explain the recoverable amount, carrying amount, all these things in detail, මෙන්න මේක important paragraph. Paragraph 9. An entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired. Underline the word indications. This question should come to your mind. How do we know whether asset has been impaired or not? කොහොමද අපි දැනගන්නේ asset එක impaired වෙලාද නැද්ද කියලා? The standard clearly explain you to identify the way you should identify the indications. Right. If you go to paragraph 12, paragraph 12 explain you, in assessing whether there is any indication that asset may be impaired, the entity shall consider as a minimum following indications. Standard has given you some guidelines. So these are the indications. When you look at, when you identify impairment, it has two indications, two type of indications. What are the two type of indications? Internal and external. It can be external indication or internal, right? External or internal. External explain you, these are the indications. What they are? External sources of information. I have highlighted. There are observable indicators that asset value has been declined during the period significantly more than would be expected as a result of passage of time or normal use. Asset value has been declined during the period significantly, external indication. B, significant change with an adverse effect on the entity have taken place during the period. Examples, one other. Technological, market, economical or legal environment in which the entity operates or in the market which an asset is dedicated. Significant change in the adverse effect. The entity have taken place during the period. Now let's say technological, right? Let's take mobile phones, right? Today if you purchase one phone, or let's say Apple phone at 100,000 rupees or 200,000 rupees, after 2 years because of the technology change, the value of that asset will be changed. So if it is highly technical, technology oriented assets, this is what external indicator. And the market. So market also will be keep on change. You are living in a dynamic environment. Therefore, market changes also has direct impact on your asset value, external indication. C, market interest rate or other market rates of return on the investment have been increased during the period. So when the market rate increase, how it has impact on your asset? Those increase likely to affect on the discount rate. When your market rate increase, it has impact on what? Discount rate used in the calculating assets value in use. When you calculate value in use, present value of future cash flows, if interest rates are increased, what happen? That has direct impact on your present value of future cash flow. Why? It has direct impact on discount factor. So this is also one external indicator. D, the carrying amount of the assets of the entity is more than the market capitalization. So that is also indication. So these are the list of indications. So internal indications also there are. Evidence of available physical damages. If there is any physical damage to the assets, impairment indicator, right? So F, assets become idle. These are examples. Assets become idle, plan to discontinue or restructure operations to which an asset belongs, plan to dispose an assets before the previously expected date, and reassessing the useful life of an assets as finite rather than infinite. So these are the examples of internal indications, right? So evidence is available from internal reporting that indicates economic performance of assets or will be worse than expected, adverse economic performance, right? So when you purchase today an assets, it will capable of generating, let's say, 100,000 units. But when it's come to 2 months or 3 months later, when you take the output has reduced. Economic, but performance of that assets will be very much lower. If so, that is also internal indicator. So here, impairment indication, both internal and external indicators, they have explained in paragraph 12. So here, para 12. 12 explain you internal and external, what? Internal and external indications. So we have learned two paragraphs, paragraph 5 and paragraph 2. Paragraph 5 is to explain the scope of the standard and what is captured to the standard, and paragraph 12 explain you the indication. So if you are seeing these indications, you have what? Impairment, right? That is also much more important before we learn this standard, right? With that, we'll try to assess the recoverable amount. When you measure the recoverable amount, I told you recoverable amount is the higher of value in use or fair value less cost to sell. Whichever is higher, you recognize as recoverable amount. When you calculate this recoverable amount, these are the guidelines from the standards. So we have done few simple examples. We'll try to understand what the standard is explained to you, right? Fine. Fair value less cost to sell, right? We'll take first fair value less cost to sell. So here fair value less cost to sell means you have two elements. Fair value less cost to sell means you should assess fair value first. So then you have to identify what are the costs that you can reduce from that fair value. Fair value means SLFRS 13. You have a different or separate accounting standard, SLFRS 13. So I'm not trying to explain you right now the fair value. How do you measure the fair value? Fair value means different accounting standard, a separate accounting standard, SLFRS 13, right? When I explain SLFRS 13 next day, I will tell you how to derive this fair value. For the time being, understand that this is there. This has clearly explained you what in paragraph, standard SLFRS 13. That's why they have deleted from paragraph 25 to 27. They have explained the way you measure fair value in the relevant standard. Deleted, and you can learn it from where SLFRS 13. In the same place here, you can say SLFRS 13, right? Fine. Then cost of disposal, cost to sell, fair value less cost to sell. Cost to sell, cost of disposal other than those have been recognized as liabilities are deducted in measuring fair value less cost of disposal. Example of such costs are legal cost, stamp duty, similar transactional taxes, transaction taxes, cost of removing the assets, and direct incremental cost of bringing the assets into the condition for its sales, which is conversion cost. So these are the examples. So these examples clearly explain you in paragraph 28. Cost of disposal, paragraph 28. Para 28. So fair value less cost to sell, fair value explained in SLFRS 13, cost to sell explained with example paragraph 28. That's about what? Fair value less cost to sell. Value in use, very simple. My standard book කියවන කාර්යය අමාරු දෙයක් නෙවෙයි. Very simple. In order, you have these things. It's a matter of highlighting and keeping these things in your summary conceptual visualization with the reference. Don't remember these things. 10 පාර කටපාඩම් කරලා ලියන්න උත්සාහ කරන්න එපා. Value in use. The following elements shall be reflected in the calculation of in the calculation of assets value in use. So these are the things you can include when you calculate what? Value in use, right? Fine. Value in use means present value of future cash flow into discounting factor, right? Present value of future cash flow explained in this paragraph. The following elements shall be reflected in calculation of assets value in use. I'll take you through quickly on this. An estimate future cash flows, the equity entity expected to derive, expectations about possible variations in the amount of timing of those future cash flows, the time value of money represented by the current risk-free interest rate. Risk-free interest rate means basically in Sri Lanka government bond rate, right? And the price for bearing the uncertainty inherent in the assets, and other factors such as illiquidity that market participant would reflect in price in the future cash flows the entity expected to derive from the assets. So these are the general guidelines to calculate what? Value in use. Further, if you move to paragraph 33, basis for estimates of future cash flows. This also has two things, right? When you calculate present value of future cash flows, you have future cash flows, you have to discount by using appropriate discounting factor. We are not talking about discount factor here, we will take discount factor separately, but in this paragraph 33 explain what? How do you take future cash flows, right? Fine. So 33 explain these things. I am not trying to take you all through this entire paragraph, but important things I have highlighted, right? In measure and value in use, an entity shall base cash flows view projection on reasonable and supportable assumptions. Right now, you know, future cash flows. Future cash flows means not the actual cash flows. So when you calculate future cash flows, you have to come to reasonable assumptions. Your sale can be this much, your demand can be this much, your selling price can be this much. All these things are estimates, assumptions. When you consider those estimates, assumptions, those things should be what? Reasonable and supportable assumptions. Those should be reasonable and all assumptions should be what? Supportable. Right? All assumptions should be supportable. Second thing, B. And you can take what? You can take base cash flow projection on most recent financial budget forecast approved by the management. Right? One word you should highlight, I have not highlighted it, most recent financial budget. Right? So when you take future cash flows, you can take what? Most recent financial budgets forecast. Why? You don't have actual to calculate what? Future cash flow, present value future cash flows. When you take it, most recent budget and the forecast that you can take. But if there is any significant deviations with the budget or forecast with the actuals, you can't take budgeted figures. Why? If there is a big or the huge difference, those are not what? Reasonable. It should be reasonable. If not, you can go ahead with what? Actuals. Right? Fine. And the same paragraph, if you look at the last line, the projection based on this budget forecast shall cover maximum period of 5 years unless a longer period can be justifiable, right? So if you can't justify longer period which is more than 5 years, you can take how long? 5 years. It is practical, no? අවුරුදු 5කට එහා පැත්තේ cash flow එකක් reasonably ඔයාලට පුළුවන් ද බජට් මේ focus කරන්න? No, very difficult. That's why standard has given you guideline. You can take maximum 5 years, but you can take it unless longer period can be justified. If you can justify with what? Relevant supportable evidence, you can take it. But if not, you can't take it. So those are the general guidelines of the standard. So paragraph 33. Value in use, future cash flows, when you take it, future cash flows, paragraph 33, right, 33, explain you general guidelines, general guidance, they have given you in this paragraph, right. Then paragraph, you have another paragraph, 39. Composition of estimates of future cash flows. Estimate future cash flows shall include projection of cash inflows. Projection of cash inflows. Then projection of cash outflows that are necessarily incurred to generate cash inflows. මෙන්න මෙතන කියන cash inflow එක generate කරන්න ගියපු cash outflows ටික you can consider. When you consider cash outflows, that must be necessarily incurred to generate cash inflow. What are the cash outflow to generate cash inflows? So those two you can consider, right? And net cash flows, if any, to be received for the disposal of assets and the end of the useful life. This is what? Investment appraisal. In management accounting, you have calculated enough present value of future cash flows. This is the guideline. Same thing you can apply, right? So 39, paragraph 39 explain what should be include. 39 explain what? Include. These things can be include, shall be included, right? So this word is there, shall be include, right? This is also very much important. Shall be includes. Then paragraph 44, right? When you calculate value in present value of future cash flows. Future cash flows shall be estimated for the asset in its current condition. Estimates of future cash flows shall not be included estimated future cash flows or outflows that are expected arising from. Underline the word shall not include, which means paragraph 44 explain you exclude. These things exclude. Paragraph 44 explain you what? This cash flow should be excluded. What they are? Future restructuring to which entity is not yet committed. You have a plan of restructuring, but you don't have any commitment in today's context. Improving and enhancing assets performance. If there any cash inflow or outflow, these two will not be considered, right? According to what? Asset recognition criteria. It is not as a result of past event, right? I'll take simple example. Let's say your office building trying to restructure. Why? Because the employees' capacity has increased and office environment, trying to create in a sophisticated way, all these things considering you are trying to restructure. So based on that, you will incur cash outflow of 2 million or 1 million after another 2 years. So those things you can't consider. Why? You don't have any commitment. You don't have any commitment right now, right? So these things you will not consider, right? Fine. Exclude 44. Then if you go to 50, right? Paragraph 50 also relevant for this. Para 50. 50 explain what? Estimate future cash flows shall not include. That is also exclude. Both 44 and 50 explain what? Exclude. Cash inflows or outflows from financing activities. Very important word is financing activities or income tax receipts or payments. So these two are very important words. Financing activities or tax. Why they are ignoring these things? The reason is this. You would have learned these things under management accounting as well, right? So when you calculate future present value of future cash flows, you will discount cash flows. So when you discount cash flows, you will use what? Discounting factor. You will use what? Discounting factor. So when you calculate discounting factor, all these financial activities, interest rate and bank loan rate, all these things will be captured. Why? It's what? Weighted average cost of capital, right? So when you calculate weighted average cost of capital, interest payment, all these financial activities, cash flows relating to financial activities, basically loan interest, all these things will be captured. So then, since it will reflect in your discounting factor, here we are not talking about discounting factor, still we are talking about what? Future cash flows. Since you discount future cash flows using discounting factor, and in that discounting factor these cash flows are reflecting. Therefore, for the future cash flows you are not taking what? Financial cash flows. When it's come to income tax receipts, so the payments also we are excluding. Why? Normally you take future cash flows before the tax, right? Free cash flows before you pay taxes. So if you are taking before cash flows before taxes, why? Taxes also we are not considering. It is not an operational activity of the business. Therefore, these two expenses are not considering for future cash flows, right? Fine. So when you calculate future cash flows, these are the paragraphs that are relevant, right? Fine. With that, go to discounting factor. පිළිවෙලට වඩා යන්න පුළුවන් මේ discounting factor. එකින් එක පිළිවෙලට මේක කියලා තියෙනවා. Discounting factor explain you in paragraph 55. Para 55 discounting factor. Paragraph 55. 55 explain what? The discount rate shall be pre-tax rate that reflect current market assessment. Pre-tax rate. Discounting factor should be what? Pre-tax rate. That's why you ignore tax payment or receivable from your future cash flows. All cash flow should be before the tax. Discounting factor also should be what? Before tax. Pre-tax, right? Pre-tax that reflect current market assessment. The time value of money and the risk specific time value of money means, you know, weighted average cost of capital. When you calculate it, you will take time value of money, right? Which means the present value of future cash flows basically. The risk specific to the assets. Risk specific to the assets means, right, you know, let's say assets in Jaffna and assets in gold, or the property in Batticlo or property in Colombo has different risk profiles. Now earlier, if you have a building there in Jaffna because of war, it has specific risk to that asset. Let's say you have a big building close to the sea, there's a specific risk, corrosion risk or tsunami risk or natural disaster risk. If you have a property in let's say Horton Place, if there is any natural disaster, I don't know properly, but let's say landsliding or flood, whatever, specific risk factors. Depends on what? Geographical locations and some other different factors. Each and every asset has specific risk characteristic, right? Those specific risk characteristic also you have to adjust when you take your discounting factor. 55. Not only in 55, take A17 and A18 explain how to take this appendix, right? A means appendix. So මේවා පිළිවෙලට දන්නේ නැති ඉඳ තමයි මම මේ එකින් එක කියාගෙන යන්නේ. So then ඔයා හෙට ආවොත් මගෙන් I can't remember these things. Why? I can't remember all these sections in my head. That's why I have a standard book. That's why examiner is allowing you to bring this standard book to the exam hall. Right, appendix A17. Yes, I have highlighted these things, same thing you can do at home, right, before the exam. A17. As a starting point in making such an estimate, the entity might take into account following rates. The entity weighted average cost of capital determined using the techniques such as CAPM model. CAPM model, you are much more familiar with this. How do you calculate CAPM model? So paragraph 55 and A17. CAPM means expected return equal risk free rate into beta factor into market risk market minus risk free rate. So which is risk premium into beta factor, right? So this is how do you calculate expected rate using CAPM model, right? Using beta factor and the other market condition. So that is the formula there in the board, right? Fine. So paragraph 18 also relating to discounting factor. However, the rate must be adjusted. This rate can be adjusted. You will calculate CAPM model rate, but you have to consider you have to adjust this rate. Consideration should be given to the risks such as country risk, currency risk and price risk. So slightly you can adjust by considering other risk factors relating to that asset, such as what? Country risk, currency risk, price risk. Meva use karla meka you can adjust. A18 also applicable for what? Discount factor calculation. So that's all about what? That's all about value in use calculation using present value of future present by discounting future cash flows using appropriate discounting factor. Right, fine. Now look at this summary. So within 5 minutes I can summarize with the relevant standard paragraph. Now I explain this model first, already explained, and I inserted all these paragraph to this. So I recommend you to have this nice conceptual visualization in your standard book, right? Within 1 minute I can summarize. Impairment means the difference between carrying amount and recoverable amount. That is not the impairment loss. To have impairment loss, always carrying amount should be higher than recoverable amount. So carrying amount, how do you calculate carrying amount? Carrying amount equal cost minus accumulated depreciation minus impairment. Impairment is equal what? Carrying amount. This is accounting carrying amount. Recoverable amount means fair value less cost to sell, value in use, whichever is higher. Okay, that's a simple model. Right? Now standard, if I go to standard, මොකටද මේක apply වෙන්නේ? Scope explain you some standards clearly explain the way they should impair in the relevant standard. LKS 2 explain the way they should impair the inventories. How? Explain කරන්න කොහොමද LKS 2 එකේ inventories impair කරන්න කියලා තියෙන්නේ. Cost or net realizable value whichever is lower. That has been explained in the relevant standard. Therefore, no point of talking about that in this LKS 36. We are not considering LKS 2 here, out of scope. What is in LKS 16? Property, plant and equipment using revaluation model. Right? LKS 38, intangible assets measured at cost. Biological assets measured at cost. So these standards will be applicable for what? Impairment. But it should be what? Under cost model. Paragraph 5 explain clearly that. එහෙනම් මේ ටික තමයි මොකටද අයිති වෙන්නේ? Impairment කියන standard එකට. So how do you identify impairment? මොකද්ද මේ impairment කියන්නේ? Right? When you impair assets, there are internal and external evidence. Right? Internal and external evidence. So internal and external evidence explain in which paragraph? Paragraph 12. Paragraph 12 explain what are the internal and external indications. Right? Fine. So then how do you calculate recoverable amount and carrying amount? Standard has given you the guideline. Recoverable amounts means fair value less cost to sell or value in use whichever is higher. How do you calculate fair value according to the standard? Standard clearly explain you have to apply SLFRS 13. Right? When we discuss SLFRS 13, you can learn that. Cost to sell clearly explain you in which paragraph? 28. 28, paragraph 28 explain you. These are the list of examples that you can deduct when you calculate fair value less cost to sell, which is market value. Right? Net realizable value. So then present value in use means future cash flows you have to discount using discounting factor. How do you calculate? How do you derive future cash flows? Paragraph 33 has given you the general guideline. Paragraph 39 explain you these are the cash flows that you can include. Paragraph 44 explain these are the cash flows that you can disregard. Paragraph 50 also explain these are the in cash flows you should ignore or exclude. When you calculate discounting factor, paragraph 55 explain you the relevant information has given you, and A17 and A18 also explain the way you should calculate discounting factor. A17 explain you take CAPM based expected rate of return as discounting factor, and A18 explain you have to adjust risk profile, currency risk, country risk and price risk. Paragraph 55 explain you don't consider taxes and financial cash flows. Why? 55 given you the general guideline, right? It explain you basically you have to take what? Pre-tax discounting factor, right? Fine. So that is the standard summary in general. And I wanted to highlight another thing. When you consider impairment, right, you have how frequently you have to do. If I go back to the standard, top of the standard, right? So look at this. This paragraph is little important. That's why I am showing this. Right, paragraph 9. entity shall assess at the end of each reporting period whether there is any indication that an asset may be impaired. Underline the word, at the end of each reporting period whether asset has been impaired if any such indicator exists. අපි කතා කරපු internal or external evidence එකක් තියෙනවා නම් at the end of the each reporting period you have to test for impairment, right? Whether there is any indication of that asset has been impaired. If any such indicator exists, the entity shall estimate the recoverable amount of that asset, right? Paragraph 10 is the important thing. Irrespective of whether there is indication of impairment එකක් වෙන්න indication external or internal තිබුණත් නැතත්, irrespective, an entity shall also test an intangible assets with infinite useful life or intangible asset not yet available for use for impairment annually by comparing carrying amount and the recoverable amount. So intangible assets subject to what? Annual impairment, whether any indication available or not. B, same thing, test goodwill acquired in the business combination for impairment annually in accordance with the paragraph 80 to 9. So irrespective of indications are there or not, for intangible assets with infinite lifetime and goodwill acquisition in business combination is subject to annual impairment testing, whether indications are there or not. If not, for other assets, if there is any indication of impairment, internal or external, you must apply impairment, right? Fine. That is the summary of the standard. Now we will see some of the questions to get familiar with this standard more. Right. Take this example. Fernando Property Private Limited acquired a property on 1st January 2004 at a cost of rupees 8 million and commenced depreciation over a 50 years useful life from this date. The company applied the LK 16 revaluation model for the subsequent accounting of property and the revalued for the first time to rupees 8,544,000 at 31st December 2005, continuing to depreciate it over the original terms. During 2006, there was commercial property crash, impairment indication. As a result, the recoverable amount of the property fell to 7.4 million at 31st December 2006. Fernando Property do not make an annual reserves transfer in respect of revalued property. Requirement is what? Demonstrate how the impairment at 31st December 2016 is accounted for. Demonstrate. You have to show your calculations with clear evidence, right? Clear evidence. So we'll do that calculation. Fine. So I believe you have this example. Now we'll see how can we continue this, right? Fine. The Fernando Property Private Limited acquired the property on 1st January 2004, right? We are calculating impairment loss if there is any. For what? Fernando Property Private Limited. Private Limited. For this you are calculating what? Impairment loss, if there is any, right? 1st January 2004, you purchased this asset. When did you purchase this asset? 1st January 2004. let's say 14, 1st January 2014, the cost of this asset, cost equal to 8 million, all these things in millions, we will do in millions, right, and depreciate over the period of 50 years. The company applied LK16 revaluation model. Standard says LK16, if you apply revaluation model, definitely it is subject to what? Impairment, if there is any. Paragraph 9 of the impairment standard clearly explain you that. In that summary conceptual visualization, I told you to have that paragraph, paragraph 9, right, revaluation model. For the subsequent accounting of property, plant, the property, the revalue it for the first time to rupees 8.544 million at 31st December 2015 after 2 years. So, after 2 years, right, after 2 years, 31st December 2015 revalued amount how much? 8.544 millions. 8.54 millions. Now you have to identify if there is any revaluation. Why? Because they are following what? Revaluation model, right? Carrying amount, right? Carrying amount. Hold on. Carrying amount of this asset you have to calculate, right? When it's come to 31st December 2015 on the same date, carrying amount calculation, right? So, your property value 8 million, you depreciate over the period of 50 years, and after 2 years means remaining life how much? How many years? 48 years. 48 years. If you look at carrying amount at the end of 2 years, 7.68 millions. 7.68 million. So, then you have revaluation gain. Revaluation gain of 8.64. What is the double entry for this? Revaluation reserve. Revaluation reserve. Your reserve. A credit, asset, value has been improved, debit. So, you will recognize revaluation reserve through what? OCI, right? OCI. So, then they are talking about some other informations. During 2016, there was commercial property crash, and as a result of that, the recoverable amount of the assets of the property fell to what? 7.4 million when it's come to 31st December 2006. When it's come to 31st December 2016, after another year, after 1 year, right, recoverable amount was 7.4 million. All the information they have given to you, right? Recoverable amount 7.4 million, right? Now, 31st December 2016, again you have to calculate what? Recoverable amount. 31st December 2016. How do you calculate recoverable amount? Now, you have cost of you have revaluation amount 8.544 million, right? Now, read this sentence. LK16 revaluation at 31st December 2015, continuing to depreciate it over the original terms. Original terms means there is no change in lifetime. There is no change in lifetime, which means you have remaining lifetime 48 years. Why? Because already you have depreciated 2 years here. Now the remaining lifetime 48 years, but from 2015 to 2016, another year has been depreciated. Therefore, carrying amount should be 47 years. So when you calculate carrying amount for 47 years, it is what? 8.366 millions. 8.366 millions. Right? So the current or the carrying amount. Now you have carrying amount and recoverable amount both. Carrying amount is more than the recoverable amount, therefore you have impairment of how much? 0.966. Very simple calculations, right? Here this is not that much complex. Why? Because you don't have value in use given, only recoverable amount. We don't know whether it's fair value less cost to sell or value in use, right? Fine. Anyway, you have what? Impairment. So what is the double entry for this, right? How do you recognize this impairment loss? Now standard has clearly explained you, right? If you go back to the standard, right. So this is a paragraph. The objective of standard is entity to recognize impairment loss, and standard also is specified when an entity should be reverse in an impairment loss and prescribe disclosures, right? Fine. Now we are trying to reverse impairment, right? Not reverse impairment. Now here that is objective, but I want to tell you something different, but we haven't discussed that yet. But anyway, look here, right? If you can take this double entry, you have revaluation already recognized and you have impairment here. Standards is telling you, if you have revaluation, if you have done revaluation earlier, before you recognize this in your P&L, so impairment double entry is that, recognize impairment loss in your P&L, right? When you recognize impairment loss in your P&L, you can't do that straight away. Why? You have to first consider earlier or previously identified or earlier identified revaluation as well, right? Fine. Therefore, you have revaluation reserve, therefore you have to debit revaluation reserve, right? Revaluation earlier identified 0.864, debit revaluation, and balance you can debit to what? P&L, right? Out of 0.966 you deduct 0.864, then balance you have 0.102. So this is the P&L impact. So then you have to credit entire amount to what? Asset, which is 0.966. So this is the accounting double entries, right? Very simple calculations, but there are very complex calculations from impairment. These things will not be tested in your exam, but I wanted to give you the high level understanding about impairment and with numbers. So we have done three simple questions, but when it's come to cash generate in units and discount in factor, when you consider value in use, present value of future cash flows, there are some complex calculations, and you should be able to identify impairment, whether impairments there or not. All these things will be considered during next day session. So next day session we will continue impairment standard balance part, and we will start SLFRS 13, which is a very important standard, but not that simple to understand. Examiner is always testing these things. So at the end of the session, I will tell you, we will do some entire past paper analysis. So based on that, we will try to predict whether these standards can be tested or not. But impairment, most of the time, I believe this can be tested. Why? Because there is no much more questions if you look at the history, right? Fine. Thank you. We'll meet next day.